Hello, everybody. We're back. It's just after 1 o'clock. Mr. Radigan, how are you? Truth or Skepticism Wednesday.
Just up here enjoying some of the financial media. Just been consuming some of the.
Don't even think you're going. Don't even think you know where I'm going, because you don't even know where I'm going today. I got control. I am in the what do you call it? The pilot seat. You're the co-pilot today.
Okay, consider me happy to be along for the ride, sir.
Yes. I'm just watching really a little bit right now. The Fed just came out with their 1 o'clock. Not that I care what the Fed does one way or the other.
Well, Ilya Spivak, most assuredly.
Oh, Ilya's right now. He's face
deep in words.
Yes, he's face deep in words.
One word after the next. He's looking for some word or another word or some combination of words.
I was actually hoping for exactly what just happened, which is a little bit of a sell-off in the bonds and the 10-year notes. I just bought a handful of notes here. I'm pretty happy with my purchase. I know you got like the NVIDIA sort of sag coming into the number. I think I just bought the bottom in the notes, and I scoopy them just about 3 minutes ago or 2 minutes ago. Well, yeah, it's 1:01, and I am NVIDIA. I'm waiting for this afternoon. It's one of the major earnings announcements. I am playing it to the short side, but it's already down $50 last. I'm playing to the short side. There's nothing else to it. Anyway, so I have a topic, and it kind of involves. It doesn't really involve you directly, but indirectly. All right. There was an article. Well, before I get to the article that I'm basing this topic on, I would just like to show everybody a very short clip here. John, can you roll it?
The amazing trick of making $3 billion in 3 months' time while the entire financial system collapses, foreclosures are at a record, and unemployment skyrockets, and the U.S. dollar collapses. Shall we begin?
Facebook.com. Mark, if somebody was to put the question to you about the magnitude of what you think you've launched, how big do you think your product or your service is?
Well, it's impossible to tell.
You said something interesting, which is not within their economic means. Yeah. I don't know that their economic means should take precedent over public interest.
Welcome back. Here's a story to add to your bailout rage. It turns out we weren't told the entire truth about the banks. Honestly, you're probably not even hugely surprised by that. That's your plan for financial reform: printing presses and accounting fraud. And it's happening at the expense of you, me, John, and every future person in this country because...
John, that's great. We got a taste of Dylan on CNBC back in the day. Can you go to the next little slide, the next little presentation, just real quickly? And you'll get an idea where I'm going with this. The next presentation, real quick, just a fun little thing we put together. I'm one of your buddies. We're queuing it up.
Stay tuned. Coming up on Bad Money with Jim Blamer. Jim lets his viewers in on a little secret.
People think I do a lot of research, watching the market live, talking to people, getting on the horn, talking to CEOs. But I don't. I watch Tasty Trade in the morning. It's great. Booyah.
Okay. There, the little bit we did a couple years ago. Okay. There was an article that just came out, and it was in Slate. It's just a magazine, Slate magazine, and it's written by a guy named Andrew Feinberg. I don't know if you know him. He's a.
I know the byline.
Yeah, he's a writer for. I think he was with Bloomberg, New York Times. He's been around.
Classic, super smart, super detailed, super qualified, probably left-leaning Manhattan-based financial writer.
Call him whatever you want. Left-leaning has nothing to do with this.
Okay, let's see.
But it was in Slate, and it says that the byline is "Step away from CNBC." Okay? Step away from CNBC. And his argument is that the entire article and the whole discussion is that if you watch CNBC, and I don't think, and just to be fair, you know, I did a hit last night on CNBC at 7 o'clock last night. I mean, I have no issue with CNBC. In fact, my discussion today is well, I don't want to tell you where I'm going with this. I want to hear your side first. But Andrew's whole point here, which I think is really important, is that people who he writes, if you want to make money in the stock market, change the channel. If you want to make money in the stock market, the last thing you should do.
So I understand the headline. What are the three citations, the first principles upon which he builds his thesis?
His thesis is basically that the people and the guests that they have on there are essentially just talking their book. They're usually,
it's a marketing platform.
Yeah, they're usually more wrong than they're right. They get you. They sell fear. They get you to make.
Illusion is a sin, false confidence.
But they also get you to get out of positions that you should hold, to get into positions that you probably shouldn't.
More active than you should be.
Way more active. He quotes a bunch of like old studies.
Too active, makes you too active would probably be his number one.
You know,
criticism.
it's the old Jack Bogle argument. He quotes too many
shots.
Quotes things from the 90s, you know, like if you stop yourself out here and then, you know, that's going to be the bottom. And then, you know, like you're going to overtrade. You're going to, you know, these guys are always wrong. They underperform the markets, even in their own portfolios. They don't buy the good stocks. They just buy the crap stocks, or they're not overweighted in the good stocks. Like, you're supposed to know what a good stock is. But all those kind of, you know, those
it's
really
an alarming headline, but it says CNBC is bad for your financial health is the headline.
Basically. And what's so interesting to me is that one of the reasons that we started Tasty originally is not because I thought CNBC was bad for your financial health, because it's just like, if I own a really good burger shop, I don't want all the other burger shops around to go out of business. I just want to build a better burger shop. You know, like I think my burgers are the best, but I don't want all the other burgers to go out of business, like burgers are bad for you type thing. I don't think CNBC or Bloomberg or Reuters or the Wall Street Journal, just because it's not my cup of tea, it's not bad for investors. It's good for the business. It's good to get people engaged. It's good to get people their first taste. It's good to get people, you know, it's the old any PR is good PR. And I think in the same thing in the world of finance.
But is Feinberg going after CNBC specifically, or is Feinberg going after the spectrum of platforms you just mentioned?
Feinberg is going, in this particular article, he's going after CNBC specifically.
And is the focus of your discussion on today's Truth or Skepticism regarding CNBC specifically, or across the spectrum of all the public?
Mine is across the spectrum. I couldn't care less about
but they're not the same thing. I mean, Bloomberg is not the same thing as Reuters. It's not the same thing as CNBC.
Really? It's not?
No, for sure not. Yeah, different business models. Because some are a subscriber model that are customer first, and others are an ad-based model that are sponsor first. And that creates a distinctly different editorial management view on who gets staffed at CEO and what the CEO's targets are. That is different at CNBC than it is at a Bloomberg or at an FT or at a Reuters or whatever.
As somebody who kind of watches from a distance, I really, you know, we don't even have cable in our office, but as somebody that, you know, occasionally will flip on Bloomberg, I've done events at Bloomberg, I've done events at CNBC, I've done events for the Wall Street Journal, I mean, and IBD and everything else. I mean, I have no problem with those as media outlets. To me, they're all the same. I don't agree that they're.
And would you indict all of them in the Feinberg lens of consuming?
No. My whole argument is
too active.
No, my argument's the exact opposite.
What I don't want to do is I don't want to defend it, because if Feinberg is specifically saying CNBC makes you too active, and then you're taking a logical leap from Mr. Feinberg's authorship through some form of mission creep to the broader financial media. I just think that there are different indictments. I think CNBC is uniquely powerful and uniquely risky.
I think when you go after,
it's different.
I think it's a lot easier to go after the biggest fish, And I know Bloomberg is worth the most money, but that's not the network part of it. So I think that when you talk about business news and when you talk about financial media, the first thing anybody would default to is CNBC. So
You're saying CNBC is a symbol for
Yes.
the mainstream financial media.
Yes, I do think that is the case.
And the indictment implies across the symbology, not
That's
just
right.
its specific.
I don't think his argument would be any different after watching 8 hours of Bloomberg.
And he's saying you're better to give them your money and forget about it.
He says the same thing that, Jack Bogle used to say.
He's running index.
You're better off doing whatever it is you want to do and going to sleep for the next 20 years. Essentially.
Then screwing around with CNBC.
Then screwing around with anything. Right, exactly. Because you're hurting yourself by watching. And I know that the genesis of building Tasty was to build something different that we thought was about optimizing mechanics more so than it was about, anything like what we thought directionally or what. We don't have guests just for that reason. We don't have news just for that reason. But that's what that was the beauty of Tasty. But to me, that article and that whole discussion really gets me. So when people go, because people say it all the time to me, they even somebody created a fund that did the opposite of what Cramer does. And I don't think they understand how important, whether you like Jim Cramer or you hate Jim Cramer, whether you think he's smart or he's a goofball, or whether you think his picks are great or they're complete garbage, or you buy the newsletter or you don't, whatever it is, the bottom line is, has he introduced more people to the world of finance? Has he got them started on a path to managing their own money or doing something on their own rather than blindly writing a check to somebody else and turning your money over to them? And the answer is no question about it, he has. And for that reason alone, he is a valuable asset to the world of finance. Same thing, forget Cramer, I'll use myself. I like to say this in some of my speeches that I give. I think that over the last 24 years of doing this, from being off the trading floor, I have cost people a lot of people a lot of money for a lot of things that I've said. There's no question in my mind that that some people have lost money. Some people obviously made money. Some people lost money. But in the end, have people lost money? And the answer is, of course. But the other side to it is, have there been a number of people whose lives have been forever changed? Have there been a number of people who have made fortunes, literally tens of millions to hundreds of millions, to build businesses and financial empires from watching this show? And the answer is 100% yes. Have we done a lot more good than bad? And the answer is yes. And all you can control, you can't control everything. You're going to have people that are outliers on both sides. But in the end, do more people finish above the midpoint line? And the answer is no. It's unquestionably yes. And does the same thing apply to CNBC? I would argue unquestionably yes. Bloomberg, unquestionably yes. And so for articles like that, especially from financial writers, it really does piss me off, because I don't think they get what this business is about.
I disagree with you.
Okay, I love that. I mean, I really do love that, because I think you're the perfect person, because you've been on, you like me in a different way. You've been on both sides of the aisle.
So I disagree with you. I'm going to tell you why.
Okay, good.
There's two different businesses here. One is the business of the path of least resistance to provide the average person with a sense of financial security with the least amount of bandwidth from their lives, which is seen as a North Star for a lot of the financial planning universe. Another North Star is engage people in the financial markets. They become bigger, more buoyant, prices get better, you get better prices. Everybody makes more money because the party gets bigger. It's 10 million contracts, it's 20 million contracts, all that. And none of that exists without the entire financial media apparatus, from CNBC to Tasty Trade to the Wall Street Journal to publicly to NASDAQ, the whole infrastructure to support disclosure and dissemination and money and all that. And what I'm hearing you say is that the role of financial media is marketing for participation in the financial markets, which you argue is good for the individual investor, but which is most assuredly good for anybody who's in the business of selling services to individual investors. And on the other hand, you have a North Star that is path of least resistance, smallest amount of bandwidth. If you're paying attention to this liquidity magnet, all these stories that'll suck you into active investment, right? Whether it's an oil story, it's a bond story, it's an NVIDIA story, it's a crypto story, whatever, which is the lifeblood of the entire financial media and the IPOs and the research houses and the financial media. Like, here's a story, right? Today it's NVIDIA earnings. Tomorrow it'll be this. Tomorrow it'll be that. That's why it's such a joy, because there's always some thread to pull on from somewhere in the world that goes into it. And what sounds like what Mr. Feinberg is saying, not having read it, is that any of that may well be entertaining for you, but it comes at a cost. And it sounds like what you're saying is that's wrong. That it comes at a benefit, not just to the salesman, but also to the customer. And in fact, you're harming the customer by giving them the narcotics of your path of least resistance and seducing them into this 20 years and go to sleep concept, when they would actually be much better off on Tom's side of the world, engaged in some component or subcomponent of the financial media and some form of active management.
Mm-hmm. Okay.
And so, because those two things are constantly conflated, basically, no one makes the distinction like what we're discussing here. They're all just taken as the same thing. So it's either active or passive, and this sort of never-ending thing. And the best thing that could happen for active is more stories of people who are doing it successfully. Because socialization on active is that it's going to take some more time. Like, it's a decision. You go from no time or very little time to more time. That's the biggest issue, I think, where you're like, well, how do you want to, because not every doctor, dentist, pilot, all these accounts that go through all these RIAs that Mr. Feinberg is writing to or watching CNBC. They shouldn't be, the more time they spend, the worse their returns get. And I'm sure Feinberg cited statistics to say it.
Yeah, he cited statistics from some statistics from 1990s and some statistics from the early 2000s, before the commissions had dropped, before the technology was better, and before people had access to all the marketplaces and stuff. How could you possibly make the argument that less is more?
No, it's not about less is more. It's about alignment of incentives. And
I don't understand the alignment of incentives. How could the alignment of incentives ever favor the uninformed?
Because the informed tend to make worse decisions, I think, is what Mr. Feinberg's point would be. Although I have not read the article, and so I want to be cautious in defending the text, as I have not borne witness to it myself. But I do believe the crux of the argument is that enhanced engagement leads to diminished returns, and as such is not to be partaken of, I believe, is the premise of the Feinberg.
Sure, of course. Assume that the fair answer to that is that every bet you make, every decision that you make is basically 50-50. Just assume that, okay? Then the argument is, because it's fair. Some of the things they say are going to be right. Some of the things they say are going to be wrong. Let's just assume they're 50-50, which is totally fair in any argument you can make. If the outcome of everything they talk about is 50-50, okay, in the end, now does your response change?
No, because my passive return is not 50-50. My passive return is some sort of historical implication of 5 to 10% a year forever. True or false?
So if your passive return is greater than your active return, okay,
or less than, because I only have to make one decision. You want me to make 50 decisions, 100 decisions,
Right.
200 decisions.
Right. I do. And I don't
I
care.
can make one decision.
I understand.
And instead of making the decision to go from one decision to a never-ending chain of decisions
Yeah.
at 50-50,
Yeah.
by partaking of your 50-50 little decision machine,
Yeah.
that it creates a diminished return for me, the CNBC watcher. Again, I'm putting words in Mr. Feinberg's mouth here.
That it may.
And so I want to be careful.
The key word is may. It may lead to a diminished return. It could also lead to a significantly improved
But no
return.
one seems to be able to tell me the probability.
It's 50-50.
So half the people will do better than the market.
Yeah.
And half the people will do worse than the market.
Right.
And how much better than the market will that have to do? It'll be some distribution. You'll have no answer.
His argument in the article, his argument was 1.6% worse.
He did some math and he said active ends up at minus 1.6.
He took the basis was essentially on like the Kramer posted portfolio versus the S&Ps, and it was 1.6% worse. That's if you had done it yourself. But here's my question to you.
Okay.
If you
are no, I want to finish. No. Hold on to your question. I believe what Mr. Feinberg is saying is that as a consequence of going from one decision to a never-ending list of decisions and time suck watching CNBC, reading whatever the financial things are, that your best outcome is basically 1.6% worse.
Okay, I'll give you that. Even though I don't think that's true, I'll give you that.
And you always go with your sort of intangible argument, which is that, let's say it's basically equivalent. Let's say the average index fund versus the average active fund is dollar for dollar. But that the human beings that are socialized to the active side are much more valuable, creative, dynamic, useful human beings in their lives and for those around them than passive investors. That is my understanding of your position.
Yes, and the other side of it is also that the study was done during a bull market, and if you weren't in a bull market,
a little goopy. I get it.
So it's skewed. Fine. So whatever. Yeah, that's exactly my argument.
But at the end of the day, your real argument is the character, the mindset, the culture of the humans that partake of this active management universe of which you speak, and that is so poorly spoken on actors, Andrew Feinberg, and it frustrates you so, is not because of the returns here or the returns there, but rather that by advocating the narcotic illusion of the one decision and go pick blueberries concept for money, you view that as catastrophic for the mindset of the culture, is my sense of you. And so the reason you're so aggressive about this is not because you necessarily believe that your returns through your methodology are better, although frequently they can be. Also, they can be worse, but rather that the mindset of the active trader is more useful to society's survival long term and those people as individuals for whatever they may so desire.
Beautifully said.
Right.
Exactly.
And so the problem is you're fighting a character war like a Greek philosopher.
I don't think it's a character war.
A culture war, then. I won't say it's a culture war for the future of mankind. And you're stuck playing a bean counter argument about whose beans gets more beans, when the whole concept of arguing about which bean counter is better is the wrong discussion, because the question is what kind of people would even use this other kind of bean counter, which is your point. And we need a society of people that use this kind of bean counter because we have to be adaptable and creative and ability to tolerate risk and.
Well, I find it interesting that we're a society that encourages one of the beautiful things about capitalism and a democracy and kind of an open system is that we encourage people to make decisions, to believe in what they say, to exercise, their ability.
They call it American individualism, I believe it's
perfect
called.
American individualism. And all of a sudden, when it comes to finance, we're told it's better to discourage that.
That's what we're told.
That seems a little disingenuous.
But the reason we're told that is because when you make more decisions, the numbers get worse, not better.
No, the
For
reason
the average individual investor.
that is something that is one of two. There's two reasons. One of two reasons for that. One is that we're in a bull market. Okay, and this is something that I guess you could argue 30 or 40 years ago, when there was no marketplace efficiency, there was no decimalization, there were extremely high commissions, money was expensive, there was a million different reasons. It's very different today. Money's cheap, technology's free, there's no commissions. I don't believe any of that stuff. It's all garbage. That whole argument, none of it holds water anymore.
No, but the argument is not based on the fees of active trading. The argument is based on the ease of passive investment.
I think one of the problems that some financial writers that don't actually trade have is that they believe that just because you're passive means that, oh, I would have bought NVIDIA at $100 and sold it at maybe 700, or I would have bought this here and I never would have sold it. When that's not the way the human mind works, that's not the way we think. That's not the way we do anything in life. That's not the way we work. And so I'm not buying into this whole discussion. I don't buy into the whole argument. I just think that, anytime we start thinking the less we know, the better, that we go down a very dangerous path. It's kind of almost going in reverse. And it's an extremely dangerous path that reeks to me of finance in the 70s and 80s and not finance in 2020.
But isn't it in the interests of those who sell financial advice and financial services to advocate for the lowest possible information base for the customer in order to justify their fees and services?
So keep them stupid and we'll make more money. I mean, there is keep them clueless and, barefoot and pregnant type thing. I don't necessarily think that flies in the decade that we're in right now. I just don't think that's going to fly at 2024, 2030, 2040 and beyond. There's no reason for it to. We're in a different era now. We're in the era of 0-day options. We're in people want instantaneous. They want instant videos. They want instant access to virtually everything. Okay, the world's changed. Nobody's going to wait till the end of next quarter to see where their money is. They want to see where it is in real time. 24 hours a day.
I can do that in an index fund as a passive investment,
and you learn nothing.
Just as well as I could make 100 decisions, 500 decisions a year on your 50/50s, and I have the detailed handle that you speak of. But I have none of the risk of making bad decisions.
Oh, you have plenty of risk because you have the risk that the bull market that you don't make 7 or 8 or 10% a year. You have the risk that you underperform risk-free rates. You have the risk that the market goes down and you lose 25% next year. You have risk. You just haven't experienced it in the last couple of years, so you don't know what it's like. But the first time you lose 25 or 30% in a year, you're going to be like, oh, it's not so great.
Again, you're talking about the boogeyman here. This
really?
Has been going on for been going on for a long time.
I know, and commercial real estate would never go down either. You buy a building and it's never going to go down by 60%. I know. And there's different markets all around the world that are, 40, 50, just look at all the Chinese investors. How the hell could both real estate and the Chinese stock market go basically down to, lose 70%? How can the Russian stock market go to zero? I'm not saying it's going to happen in the U.S., but what I am saying is that it is how could on our bond investments from 2 years ago, we lost 60%. You can't happen to stocks. It's absolutely crazy for when people start giving me that argument. Oh, it's a layup. If it's there's a reason why we don't call investing in index funds risk-free investing. There's a reason why we don't do that. Now, just because it's been risk-free investing for the last decade, Okay, that's just the way things have played out.
But
Because
they do they'll go back 20 years, 30 years. At the average, will always get you somewhere towards something.
yeah, tell the people that puked at the bottom in 2008 and 2009. I mean, tell the people that puked at the bottom in 2002. It doesn't always work that way. I mean, yeah, if you're going to hold your stuff, if you're going to Warren Buffett it for 40 or 50 years, that's fine. But I'm sick of the arguments that, hey, we never go down, so what difference does it make? People treat indexing like it is a risk-free rate. They look at it like they're buying treasuries, because in fairness, over the last 10 years, you lost a lot more money buying treasuries. You made a ton of money buying stocks, and you lost a lot of money buying treasuries. So the reality is that when you think about it, if you bought 10-year notes, you're down money, and if you bought 10-year stock funds, you're up huge. So people have been they're mixed up. They don't understand it. And the idea that we should then turn off from watching people talk about how to actively manage a portfolio, risk, individual stocks, whatever it is ridiculous to me. It's absolutely ridiculous. Look, we built Tasty because I couldn't stand the content that was on traditional media. I didn't like the Wall Street Journal. I didn't like CNBC. I didn't like whatever else it is. But the reality is they do a lot. They do more good than harm. That's my point. And
But I think that Feinberg's point is that that's exactly wrong.
I know what his point is. That's why I'm arguing it. That's why I'm having the discussion.
And I think we should mark the tape as of whatever today's date is, February something 2024, when Tom Sosnoff came out in defense of CNBC and the mainstream financial media with a vehement and aggressive and unexpected turn of events.
You know what? I can tell you something. So last night,
all of a sudden, Jim Cramer's number one guy, his number one hype man, his number one floor guy, his number one deal guy, is Tom Sosnoff. Who knew?
So last night, Dylan, I'm sitting around after the market closes, and I'm ready to get out of here. I was doing a podcast with somebody, and I get a text message, and it's from one of the producers at CNBC, and she says, "Hey Tom, we're going to talk about teenagers trading." And she goes, "I know you guys. You built an app. You love this stuff." And so I figured they're asking me because they want me to say, I think everybody should trade, everybody should take risk, and they're going to take the other side. And so I get on the show. I have no idea, and I'm doing it with Brian Sullivan, and he goes, "What do you think about all the huge growth of teenagers trading and custodial accounts, teenagers trading, and people in their 15, 17, 18, 20, 22, whatever. What do you think about that?" And I go, "I freaking love it. Everybody should take as much risk as they can." You know what his answer was to me? "I totally 100% agree with you. Everybody should trade." I thought he was going to go the opposite way. He's like, everybody should trade. They should trade when they're 12 if they could. I agree. 15, 20, 30, whatever. It doesn't matter. The more people active in the markets, the better it is. And I'm like, that's exactly the way I feel. I thought it was going to be completely the opposite discussion. Like, you never know. And
Mr. Feinberg would say that both you and CNBC are wrong.
Exactly.
Which I think is what he said.
Exactly. But
I think that the value of engagement, which is a high value for CNBC, high value for Tasty, high value for financial media, is a negative. Mr. Feinberg's point is that it's a negative. Not that it's neutral.
Yeah, he would tell me to listen to your economics.
Negative.
He would say, go back and listen to your economics professor from your junior or senior year in college and go the old school fundamental route and buy them,
which
hold
means
them.
that you anticipated CNBC to be more defensive of the more indexed positive, shall we say, more active negative, when actually what CNBC did confirm Mr. Feinberg's very point, which is that everybody is long engagement, and it's that very engagement that is bad for your health.
And I would argue that if you asked me where will tomorrow's financial gurus, where will tomorrow's financial experts, where will the superstars come from? Those are the kids that are trading when they're 16 years old and 20 and, and 19. And those are the kids that are learning everything about real-time financial markets in real time. And so I couldn't agree. I couldn't disagree with him more on every single line. I just think.
And do you have statistics or evidence of any kind? Because it sounds like he has a lot of statistics and math and sort of citations and research to support his assertions.
1990 research from like Vanguard, who doesn't offer active trading. It's all, to me, it's all garbage.
It's flawed references.
Yeah.
Do you have any references for your point of view?
We only have our own research.
And what would your own research tell you?
Well, it would tell me that I'm right.
I bet it would.
Just like their research tells them that, this is what happened 30 years ago. But our research doesn't quite confirm that.
That's the thing with research.
Yes. I did a piece of research today that just showing that, how simple active put selling in the S&Ps outperforms passively in buying the S&Ps, both from a fee structure side and from a return side and from a capital usage side. I can make that argument until the cows walk home. He would have no chance to debate me on this because this is what I do.
Well, but why don't we set up such a debate?
Because they don't do that.
Well, not only would they not do it, but the citations, everybody would spend all of their time decapitating the other side's data and citations and research.
Well, I've done this before.
Nowhere.
I did it.
Have.
I did a debate on exactly this topic at Harvard, and they didn't really want to go. They didn't really like it. They didn't want to go one-on-one on this. I've done this debate with I forgot the guy's name. He was an author of a best-selling book that had the same argument, and he didn't like the debate either. They don't, when challenged by it, because they don't really trade, it's very difficult. And they're all smart and they're all clear of the concept. It's
but you have no citations other than your own research.
Well, I have plenty of citations other than my research. I just didn't bring them. I don't have them, I didn't come prepared to cite things. I read an article. I'm commenting against it.
Right.
I didn't bring, I didn't bring a backload.
But there's sort of two vectors of the argument, though. One is the math, whatever that means, right?
We have more data.
And the other is the mindset and the culture.
Dylan, I have so much data because we own a brokerage firm. We have so much data. It's crazy. And we have so much data, exchange data. This stuff is not, it's out there. If he wanted to find it, he could get the real data.
The real data being the performance of active versus passive in 2023.
Yeah.
So you're saying the whole thing is lazy because it's using this research from 40 years ago.
Yeah, the CBOE, the Chicago Board Options Exchange, publishes the return of naked short puts in the S&Ps versus just being long the S&Ps. And on every which way, even in a bull market, just being short puts outperforms S&Ps. Just because the amount of capital used, the amount of less risk you're taking, the reduction in volatility, significantly lower CBAR numbers. Everything wins from just the active side. The CBOE publishes a ton of information on that. It's all out there. This isn't stuff, these guys just don't want to look for it.
I think the reason you react with so much emotion is because you know that Feinberg is right.
Obviously, you have not heard a word I've said, but
I think that Feinberg has touched a nerve.
I think you're just playing devil's advocate.
And now he's got you very animated.
No, not at all. Not at all.
Indicating a sensitivity to the fact that the worst case scenario for the entire apparatus is if hamburgers are bad for your health.
It was something it took me a while in school to figure out that if I owned a hamburger shop, do I want to be the only hamburger shop or do I want to be the best hamburger shop? And a lot of studies prove that you want to be the best, not the only.
There's no question. They've done it 1,000 times over. Hotels, It's 100% true.
Yeah.
I do think it's peculiar as probably a decades-long critic of the mainstream financial media that when Andrew Feinberg drew the line and said it was burgers are bad for your health is when you had to put down the sword and pick up the battering ram on behalf of Jim Cramer himself.
I mean, I don't watch Jim. I like Jim because I think he's good for the industry, even though we made fun of him and we have that kind of stuff. I think he knows that I appreciate what he does, and I think he's good for the business. I know he doesn't know anything, but I also think that, does he engage people in the world of finance? The answer is of course. I mean, if you sit there and you listen to him and you think that he knows something about what a stock's going to do, that's ridiculous. But I mean, are the discussions about a certain stock or markets, are those valuable?
Right, but isn't Feinberg's point that what Cramer is giving you is a list of tickers based on a list of...
But that's because Feinberg doesn't understand what his real goal is. What his real job is to get you engaged so that you come back and watch tomorrow. We have lots of people that watch Tony Batista and hear what he has to say. They're smart enough to know he doesn't know what's going to happen next, but they just find the discussions interesting. That's cool.
I think we got to get Feinberg on the phone or something. I think we've done him a disservice.
I knew you would come out. I knew you'd come out in defense of your
I got
These are your people. These are your people. I know.
You can't be. You're coming at us with this.
You probably went to school with the guy. I mean, he's probably like an old buddy. He's probably like an old Bloomberg chum. You guys probably were up to no good someday, somewhere back in the day. I got it. I hear.
Not like that. It's not like that. It's just a matter of what's empirically and observably accurate under the known and knowable data set.
All right. Well, we are out of time. So
you never told me who your AI friends are going to be. You were supposed to tell me who your three new AI best friends to replace Tony and everybody is going to be.
I'm still working on that. I'll have that for you next week. That was from last week's discussion. Yeah. I'm not sure. I didn't have to focus on that, but it's
don't forget about him.
I'm Tom Sosnoff. He's Dylan Radigan. This is Truth or Skepticism. Thanks for listening to that. It was a fun discussion, Dylan. Thank you.
Hi, Tom. Thank you.
The content of this podcast is created, produced, and provided solely by tastylive Inc.